So the relationship between equity returns and GDP growth is complicated. If you plot GDP growth in any given year against equity returns in that year, there is pretty much a zero relationship, as you can see in this chart. So doesn't growth matter? In fact, what you see is that when equity markets recover, economies tend to follow later. Very simply, if you plot GDP growth in any given year against S&P returns in the prior year, the correlation jumps from 0 to 65%, as you can see in this chart. It's not perfect because companies are multinational and the rising influence of share buybacks, but it is a much stronger relationship. So what information do we actually need to know when thinking about equity returns over the next year? Basically, a perfect forecast of 1 year ahead GDP growth. The point is, equity markets look forward. The key is that equities hope for growth tomorrow, and that puts more emphasis on two things when thinking about returns today. First, unexpected changes in economic growth, i.e. surprises in the data which can shift expectations of the future. You can see, for example, a strong relationship between European equities shown here in blue and surprises in the economic data relative to expectations captured by the Citi Economic Surprise Index in orange. Second, aside from data surprises, history shows that the most volatile and significant cause of return variation is market valuations, i.e. changes in the PE ratio and not earnings. So let's now plot GDP growth against the S&P PE change over the same period. And you will see an inverse relationship. GDP growth down, but PE multiples up? What's going on here? Well, valuations are the missing link. More often than not, they are pricing for risk rather than growth. And so that brings into play the policy dimension. In the high interest rate environment of the 1990s, the PE was more correlated to Fed policy than activity measures like the ISM. Think of 2009 in the aftermath of the GFC. PE saw huge expansion despite negative GDP growth on the announcement of QE. And last year, rising interest rates, raising the corporate cost of capital, was the primary drag on valuations. Finally, here we show the S&P 500 12-month forward PE against the difference between consensus expectations for 12-month forward GDP growth and CPI. The sweet spot is when GDP growth expectations are rising faster than inflation. Look at Q1 this year. Inflation was falling while GDP growth expectations were holding up, a rising growth inflation trade-off. Now this may well be more difficult into Q2, but we shall see.